How America was funded before income taxes. Before the federal income tax became law in 1913, the U.S. government relied on various funding methods to sustain itself. The United States emerged from the Revolutionary War with significant debt. From 1789, after the Constitution took effect, tariffs became the government's main revenue source. A tariff is essentially a tax on imported goods. By levying taxes on foreign products, the young government could finance itself without taxing its citizens directly. Alexander Hamilton, the first Secretary of the Treasury, supported tariffs as a way to generate funds and encourage domestic manufacturing. Between 1789 and the mid-19th century, tariffs on items like textiles, iron, and other goods were a reliable revenue source, providing over 90% of federal income in some years. This made tariffs politically significant, but also stirred debate about how they impacted different economic sectors. But tariffs alone weren't always enough, so the U.S. also turned to excise taxes on specific goods. In 1791, Congress passed the first federal excise tax on domestic whiskey production to help pay off war debt. This led to the Whiskey Rebellion in 1794, where small farmers in Pennsylvania protested against what they saw as an unfair burden. President George Washington responded by sending federal troops to enforce the law. This was one of the first tests of federal authority over state and local resistance. Although unpopular, excise taxes on items like whiskey, tobacco, and carriages remained an important revenue source, proving the government could impose and enforce taxes. As the U.S. acquired new territories, land sales became another key revenue stream. The Land Ordinance of 1785 and the Northwest Ordinance of 1787 laid the foundation for public land sales in territories like Ohio, Illinois, and Indiana. During westward expansion, public land sales became a lucrative revenue source. The Louisiana Purchase in 1803 and subsequent acquisitions provided millions of acres for sale to settlers and speculators. From the 1820s to the 1840s, federal land sales generated millions of dollars each year, allowing the government to raise funds while encouraging settlement of the western frontier. However, this system had its drawbacks, as revenue from land sales fluctuated based on economic conditions. For example, after the Panic of 1837, land sales and other revenues plummeted, highlighting the limitations of relying on land for consistent government funding. The Civil War marked a turning point in U.S. funding strategies. With the Union facing unprecedented expenses, Congress passed the nation's first federal income tax in 1861. This tax was designed as a temporary measure to raise money quickly during wartime. The tax was progressive, meaning higher incomes were taxed at higher rates, a concept still central to the income tax today. The Revenue Act of 1861 set the tax at 3% on incomes over $800, and subsequent amendments increased the rates and expanded who was taxed. Although controversial, the income tax helped finance the war effort, bringing in roughly $350 million by the war's end. However, with the war over, Congress repealed the tax in 1872, returning to tariffs and excise taxes. As the U.S. moved into the Gilded Age, tariffs once again became the dominant funding source. High tariffs protected American industries but created political tensions, especially between the industrial North, which benefited from protectionism, and the agricultural South, which wanted lower tariffs for cheaper imports. The McKinley Tariff of 1890 raised rates to an all-time high, and while it generated revenue, it fueled debates about inequality and economic fairness. By the 1890s, calls for reform grew, as tariffs alone couldn't provide a stable revenue base, and fluctuating trade meant the government often faced budget shortfalls. The 1894 Wilson-Gorman Tariff Act attempted to address this by including an income tax provision. However, the Supreme Court struck it down in Pollock v. Farmers Loan and Trust Company, 1895, ruling it unconstitutional since it wasn't apportioned according to population. This decision underscored the need for a constitutional amendment if the U.S. was ever to have a lasting income tax. After years of debate and economic instability, the push for a permanent income tax gained momentum. In 1909, Congress proposed the 16th Amendment to allow a federal income tax without apportioning it among states by population. By 1913, enough states had ratified the amendment, officially empowering Congress to collect income taxes directly from citizens. The Revenue Act of 1913 established the first modern income tax, setting a 1% tax on incomes over $3,000 and reaching up to 7% on higher incomes. This tax system soon replaced tariffs as the main revenue source, reshaping American fiscal policy. If you like this video, like and subscribe. Thanks for watching.